You know, sometimes you're just drowning in reports, right? And you wish someone could just cut through it all, pull out the important bits, tell you what it really means without all the noise, that feeling of just wanting clarity.
Yeah, absolutely. Information overload is real.
Well, that's exactly what we're doing today. We're diving deep into the latest Q1 FY26 results for Transformers and Rectifiers India Ltd, TERL for short.
Right.
We've got their official filings, the investor presentation, stuff from their board meeting on August 1st.
Pretty fresh data then.
Exactly. And our mission here is simple. Unpack the big numbers, get the story behind them, and figure out what this tells us about TERL's future and maybe even the wider industry.
There might be a few surprises in there too.
Oh, definitely. Expect some actionable insights. Okay, so let's unpack TERL itself first. Who are they? Well, they're a major player globally in making transformers and reactors. And get this. Second largest transformer maker in India by capacity.
That's significant. And to give you a sense of their footprint, they've got 3 plants, all near Ahmedabad in Gujarat. Right.
Employing around 1,200 people, highly skilled team. And it's important to remember, they're strictly B2B.
Meaning they sell to other businesses.
Exactly. Power generation companies, transmission, distribution utilities, plus various big industries. They're supplying critical stuff.
And the scale.
Yeah.
You mentioned capacity. We're talking about 40,000 MVA installed. That's a lot of power handling capability.
Huge capacity, megavolt amperes, yeah.
Plus a global reach, right? Over 25 countries. And their product list is seriously diverse. I mean, single-phase power transformers up to, 500 MVA and 1,200 kiloV class? That's top-tier stuff.
Yeah, 1,200 kilovolts is pushing the limits of transmission voltage globally. Very high-end.
Then you've got furnace transformers, rectifiers, distribution ones, even specialty transformers for things like trains, solar farms, green hydrogen.
Right, adapting to new energy needs.
And reactors, mobile substations, the list goes on. And, looking back at their journey, it wasn't always this massive scale. It started pretty modestly back in 1980 with Mr. Jitendra Mamtora just repairing transformers.
Really? From repairs to this?
Yeah, by 93, they were manufacturing 33 kV ones. Then came incorporation, listing on the stock exchanges around 2007, 2010. Big step was the Mariah plant in 2010. That really ramped up capacity. And they made some smart moves with alliances ZTR in Ukraine for the 765 kV tech Fuji Electric for reactors.
So bringing in outside expertise.
Exactly. Fast forward to the last couple of years, 2023 to 2025, they've been busy, raised 120 crores and another 500 crores through a QIP.
That's significant capital infusion, about $60 million on the QIP alone.
Yeah. Plus, they became the only Indian transformer company with an NABL-accredited lab for testing electrical steel. That's a big quality marker.
An NBL, right, the National Accreditation Board, means their testing is up to international standards.
Precisely. And they bagged their biggest order ever from JTCO 740 crores, plus a strategic acquisition for backward integration. It's like a very deliberate growth path.
Okay, so that sets the stage nicely. Now, the Q1 FY26 numbers themselves, quarter ending June 30, 2025, comparing it to last year, this is where it gets really interesting, as you said. The performance looks strong across the board, standalone and consolidated.
Maybe just quickly clarify that. Standalone is the main company, TERL itself.
Right.
Consolidated includes all the subsidiaries, gives you the full group picture.
Got it. So looking at those consolidated figures for Q1, revenue from operations hit 529.33 crores.
Which is up 64% from last year's 322 crores. A huge jump.
64%. Wow. And EBITDA?
Even more dramatic.
Yeah.
108.50 crores. That's up 135% from 46.22 crores last year.
135% increase in EBITDA. That points to serious operational improvement, not just higher sales.
Exactly. Their EBITDA margin reflects that. It went from 14.18% up to 19.74%.
That's an increase of 556 basis points. Very healthy margin expansion.
And it flows down to the bottom line. Profit after tax, PE, was 67.41 crores.
Compared to what last year?
Just 20.87 crores. So that's a 223% increase. Phenomenal growth.
223%, okay? And the PT margin?
Also jumped significantly, up to 12.26% from 6.40%. Another big basis point increase, 586 points.
And EPS, earnings per share?
Basic EPS came in at 2.24 for the quarter, up from 1.40 last year. Solid increase there, too.
And just briefly, the standalone numbers mirror this, right? Consistency there.
Very consistent. Standalone revenue also up 64%. EBITDA up 127%. PAT up a massive 227%. Margin strong too, EBITDA at 18.35%, PAT at 11.43%, EPS at 2.0.
So the core business is firing on all cylinders.
Absolutely. That consistency across both sets of results is really telling. Management points to operational efficiency and process optimization.
When the numbers definitely seem to back that up. Those strategic steps are paying off now.
Looks like it.
Okay, so with those impressive Q1 results, the big question is, what's next? How do they keep this going? Let's look at their order book as of June 30th. The unexecuted order book stands at 5,246 crores. That's solid.
Decent backlog.
But what really catches the eye is the pipeline. Inquiries under negotiation. Over 18,000 crores.
80,000 crores. That's a massive pipeline. Shows huge potential demand.
And they pulled in 665 crores in new orders just in Q1.
Yeah, that pipeline figure, the 18,000 plus Puro, is really significant. It speaks volumes about future revenue visibility, assuming they convert a decent chunk of it.
Right.
And there were some noteworthy wins in Q1 too. That big export order to Botswana,
Yeah.
USD 16.65 million.
From Jindal Energy, yeah. Shows their global competitiveness.
Definitely.
Right.
And also that first order for those STATCOM transformers.
Yeah.
The 193 MVA single-phase ones.
STATCOM, static synchronous compensator. That's pretty advanced grid tech, right, for power quality.
Exactly. Essential for modern, stable grids, especially with renewables coming online. Getting into that space is strategically important. High-value stuff.
Makes sense. And the managing director, Mr. Satyan Memtora, sounds pretty positive. He mentioned strong order pipeline growth from utilities, infrastructure, industrial sectors, and importantly, he said the revenue target for this financial year is still on track.
That's a confident statement, given the current environment. Shows belief in their execution.
He also highlighted receiving an Operational Excellence Award from Power Grid and exporting a big EAF transformer.
The electric arc furnace one.
Yeah.
Right, for steel making. Again, specialized high-value exports.
So it's not just volume, it's capability they're demonstrating.
Precisely. And then you have the chairman, Mr. Jitendra Mamtora, talking about the bigger picture, the strategic stuff. They've started construction on expanding the Mariah plant, adding another 22,000 MVA capacity.
Wow. Another big capacity jump planned.
Huge jump. Plus, expanding their CRGO processing unit.
TRGO, that's the cold-rolled grain-oriented steel, the core material for transformers.
Exactly. Super critical component. Doing more processing in-house means better control over quality and potentially costs, more self-reliance.
Smart move. Backward integration.
Yeah, and other backward integration units are also under construction.
Yeah.
It all ties into that theme of self-sufficiency and quality. And then there's the big ambition.
The billion-dollar target.
Yep. On track in our journey towards U.S. $1 billion in revenue over the next 3 financial years. That's a bold statement of intent.
Very ambitious. But given the numbers in the order book, maybe not entirely out of reach if things go right.
It shows confidence, definitely.
Okay, now digging a bit deeper into the filings, there was this one note that maybe needs explaining about a subsidiary, Triveni Transtech.
Ah, yes.
It mentioned its net worth was completely eroded as of June 30th. On the surface, that sounds kind of bad.
It does, and that's why transparency is important in these reports. But here's the crucial context. Management explicitly states that accounting on a going concern basis is still appropriate for this subsidiary.
Meaning they expect it to continue operating.
Exactly. The reasoning is that the holding company, Terrell itself, is committed to providing the necessary support, financial, operational, whatever it takes.
Okay.
The expectation is this support will help Triveni Transtech significantly ramp up its business, improve cash flow, and eventually get back to a positive net worth.
So there's a plan in place.
Yes, and importantly, the auditors reviewed this. Their conclusion was not modified regarding this matter. That means after looking at the plans, the expected support, and the reports from other auditors involved, they accepted management's assessment.
So not a clean bill of health for the subsidiary itself yet, but the auditors accept the overall picture based on the parent company's backing.
That's a good way to put it. It's a known issue with a stated resolution path, acknowledged by the auditors. It's a nuance you catch by reading the notes carefully.
Got it. That makes sense. And just to reiterate, Terrell's main business, its core operation, is focused entirely on one thing, right?
Yes, just the manufacturing of Transformers segment. That's their bread and butter.
Yeah. Okay. So, connecting all this back to the bigger picture, the industry, how does Terrell fit?
Well, everything we've discussed, their product range, the capacity expansion, the focus on green energy applications, It aligns really well with where the industry is heading.
Right, the demand drivers.
Exactly. Power sector upgrades, massive infrastructure spending, industrial growth, the renewable energy transition, all these require transformers. Lots of them.
And Terrell makes the kinds needed for all that.
Pretty much. From standard grid transformers to specialized ones for renewables, railways, mining, petrochemicals, it's a diversified demand base. Their expansion and that backward integration push, it positions them really well to grab a bigger piece of this growing pie.
Seems like they're making the right moves at the right time.
The strategy certainly seems aligned with the market opportunities.
Okay, so let's try and wrap this up. What are the key takeaways for you, our listener? Well, Terrell's Q1 FY26 results show really impressive growth, clearly. Strong revenue jump, even stronger profit growth.
Driven by solid order execution, efficiency gains, and a healthy market demand.
Right. And they're not stopping. Big capacity expansion underway, focus on strategic areas like CRGO processing, and that ambitious billion-dollar revenue target.
Plus, that huge order pipeline suggests the momentum could continue. They seem focused on innovation and shoring up their supply chain, too.
Definitely. So here's something to think about. A final thought for you to mull over. Given Terrell's heavy investment in expanding capacity, that massive order book potential, and their stated goal of hitting $1 billion in revenue in 3 years, how might the global shift towards green energy, something Terrell is actively targeting, how might that actually accelerate their growth? Or could it maybe pose unexpected challenges down the line?
Interesting angle. Like, can they scale fast enough? Or will competition intensify even more in those green tech niches?
Exactly. What are the ripple effects going to be across the whole energy supply chain as companies like Terrell race to meet this exploding demand? Something to keep an eye on.